Oh, welcome to Weekly Tax Update for March 15th, our first tax season deadline, as my friend Sheeley would say. This is also episode 97, middle-size episode, not too big, not too small. All right, and reminding you that I am coming from the Borscht Belt, here just south of the Borscht Belt anyway, in the lower Hudson Valley of New York State. Live upcoming events. This hasn't changed. You can catch me in Nevada in May in Las Vegas if you want to come in for a Wednesday of all days. Latino Tax Fest at the end of June. Agostino Barbecue as well that same week. Some exciting speakers Frank has lined up. I'll be in July. I'll be at the New York, Connecticut Association of Tax Professionals in Danbury, demystifying the consolidated 1099-B. And then June 11th and 12th, CSEA Super Seminars, which should be pretty fabulous. I'm doing two different programs on artificial intelligence, and it's overall a great program with fabulous speakers if you want to come down to Arizona. All right, if you're not a subscriber, please consider becoming one for $52 a month. You get 25 to 30 hours of new education each month, around 300 hours of recorded material available for reference this time of year, or CE if it gets to be December. We have a program coming up on March 26th, Jessica Smith and yours truly, when they owe but can't pay. So for your taxpayers who all of a sudden you tell them they owe $5,000, they say, what? That's the end of the world. Put me on extension. Well, you did the work. We want to get those returns filed, get you paid. We're going to discuss options, settlement options available to your client who owes but cannot pay the government, and why they should file timely without an extension. In the handouts, there is a resources page. The resources page is a PDF that will list all of the different things we talk about today. I'm going to put this on hiatus for a couple of weeks after today, but the early bird is still open for Nationwide Tax Forum. So registration is open. Early bird is available. I'll remind you that last year San Diego sold out very early. It is weather perfect San Diego, and hotel space got booked up in Baltimore at National Harbor. I will say this much: National Harbor this year, they have 3 hotels reserved. So one is for the event, but there are 2 right nearby. So should be very nice if that's your sort of thing. So I thought I would share something with you under they can't still be screwing this up. Got a letter in the mail for a representation case, a non-filer case we did in December of 2020 and January of 2021. We filed 6 returns. They all had to go out on paper, and off they went. And of course, some of them took 18 months, 2 years to process. I guess I missed that the 2018 return hadn't been processed yet. So we get a letter in the mail this week that said, by the way, we're not going to give you we're not going to give the taxpayer the refund because, as you can see here, it's more than 3 years old. And I said to Nicole, and this is why we send out everything in its own envelope, certified mail, electronic return receipt. I said to Nicole, there's no way. And she said, I agree. And in fact, it was her birthday that she went. So she even remembered what day that I made her wait in line at the post office. So I went and I pulled it. And now let's look at these dates. October 31st, 2022, they're saying they received it for the 2018 period. I'm going to tell you right now that's not when it was prepared or when they received it. If you can see this, January 19th, 2021. So if you do the math, the tax return was due April 15th of 19, which gave us until April 15th, 2022. As Nicole's letter to the IRS succinctly says, January 19th, 2021 is in between those 2 dates. Therefore, it was timely filed. What's more disturbing, or it was within statute, what's more disturbing is it took 39 months to process the paper return. 39 months. That might be the record. and it is for only a 300, and I shouldn't say only, it is for a $342 refund that should have been posted to his account 3 years ago or so. And they're going to take it against his otherwise large balance due, but it's his money. So just for fun. Next week, I'll post the letter we received where they denied my penalty abatement request, but they denied it on a penalty we didn't ask for and didn't address the penalty that I did ask for. So it's fun stuff at the IRS these weeks. They're trying. All right, so think of the IRS as caught up, or I'm still that far behind that I actually was able to get this week's numbers this week. These are the most recent numbers issued today, comparing March 10th of last year and March 8th of this year. Now, you need to keep in mind there are, I think, 9 less filing days this year than last year because of the difference in the start date. But we've had enough weekends and holidays that we're caught up. So we're down 1.1 returns, 1.1%, down 2.1% in processing, which is interesting. They're not processing as many as quickly. Total e-file down 0.9. Now, e-filed returns received from professionals, keeping in mind that professionals need to e-file everything they can. This is a pretty good barometer of what's going on in our industry. Down 1.9% versus e-filed returns by people, by self-prepared, up 0.1. Well, I have to tell you, with the direct file pilot, you would have thought that number would be a lot bigger. In speaking to people, the usual, they seem to be disenchanted. They have money. They prefer to pay a professional. So it's just very interesting to me. But now we get to the time of year where there are less self-prepared and more of our returns. So as we get closer to April 15th, I expect the disparity to decrease. And we'll see. All right. So interesting here. Not much movement. 1040 returns. We've moved up to the March processing. Well, no kidding. We're in the middle of the month. Amended returns, we're still in November of 2023. We just had this discussion online. Well, the IRS says this and they say that. Well, this website is pretty much their official turnaround. So if this is what they're working on, this is what they're working on. Now, that, of course, doesn't mean you're going to get the check this month, but that means they're working on those returns. With respect to business returns, they seem to be about timely processing 1120 returns. Amended returns haven't moved. We're still processing last September. 941 returns, not including ERTC amended returns. Original returns, we're processing the current month. We are still in December of 2023 for amended 941s, excluding the million or so, I think it was 1,060,000 ERTC returns. Form 1041, no movement. Other miscellaneous items, mostly there's been no movement. The key thing I always bring your attention to is the 600 plus days that it takes the IRS to process an identity theft claim, which is just outrageous. And as a citizen, I am super, super disappointed that's where we're at. Employee retention credit reminder. It was mentioned in an IRS news release this week that last September 14th, the IRS announced they were going to stop processing new ERTC claims. A resumption debt was never mentioned, and it still hasn't been determined. What are they going to do? Are they going to start? I think they're holding out hope that January 31st deadline that was proposed in the 2024 tax bill somehow actually passes and that we don't have to worry about the statute of limitations any longer. The IRS continues to process the ERTC claims that were submitted before the moratorium, but obviously it's very slow, and we're seeing more letters come out, hey, there's a problem, than we are seeing, hey, here's your check. As I indicated a couple of weeks ago, we even had that one audit where the IRS was doing basic math. You had 42 employees in 2019. The maximum credit was $5,000. Please explain why your credit was more than $210,000. In fact, they didn't even say explain it. They billed them. This isn't an audit. We still might audit you. You couldn't have made this much money. Please pay it. The IRS wants to remind you of the March 22nd moratorium. The last day to fax in an ERTC withdrawal. Drawing from our experiences with the offshore voluntary disclosure programs, you can count on at least one extension of this. First, they're going to round up their statistics and tell you what a great thing they did. Then there'll be a small delay. Then they will issue a round two to make round two be even more effective. They're going to take away something. So they let these folks keep 20%. My guess would be the next round of people, they can keep 20 or 10% of the ERTC money, or maybe none of the money, but they won't have to pay a penalty, right? So March 22nd is the deadline. You have to submit this by fax. Limited time offer where you can withdraw and not have a penalty. You can repay your incorrect amount less 20%, no amendments, and no interest. But they're kind of waiving interest on most of these anyway because they're allowed to do that on employee tax cases. Now, President Biden's budget is out, and I have to tell you that something that would have been 6th or 8th on everybody's list, I jumped to the top of my list. Why? Oversight of paid preparers. And my friend Vlad mentioned he thinks this is a whole bunch of beans because he didn't use the word beans, but he said that all they've done in his entire career is regulate Circular 230 practitioners a little harder, push more work off on tax preparers. Well, I want to draw some inferences here. So the IRS is going to grant authority. I'm sorry, Congress. This is a law. Budget is a law. So Congress is going to grant authority to the IRS for the oversight of all paid preparers. Now, my opinion, my observation, in Loving versus Commissioner, Congress did not authorize the IRS to regulate tax professionals specifically. The IRS bootstrapped the Circular 230 regulations that are at 31 USC Section 330. Now, a budget is a law, which is Congress. Congress is now saying you can do this. They would like to increase the amount of tax penalties that apply to paid preparers for willful, reckless, or unreasonable understatements, as well as for forms of non-compliance that don't involve understatements of tax. But of course, in addition to penalties, you need an enforcement budget to go out and prosecute, chase us down, audit us, prosecute us. They also want to establish new penalties for the appropriation of PTINs and EFINs. Those who have hacked paid tax pros, they want to issue higher penalties on them. Question out there. Any idea why some softwares have changed special depreciation to 100% from 80% in their recent updates? I don't know. I would think the other way around. My software says that we're assuming the extenders are going to happen, which they may not be. So I may be amending returns. I don't know. All right. Biden's total budget, $7.3 trillion in spending, $895 for defense, $621 for defense, non-defense based discretionary. They can add on to this. A wide range of tax-related policies, some of which we've heard about already in the State of the Union. Some of the other highlights include a budget of $12.3 billion for next year. Now, that's similar to the 2023 levels, but a drop from last year's proposed $14.1 billion. So my observation, are we back to the unfund the IRS? Are we now going to have 10 years of the same budget? Not a good idea. In addition to the annual appropriations, though, the president has asked for $104 billion in mandatory funding for the IRS for fiscal years 2026 to 2034. They want to allow the IRS to continue to strengthen taxpayer services, technology enforcement, the big three. This will be money to be spent after the Inflation Reduction Act money, that $78 billion. After that's gone, this is going to be the funding. They look 10 years ahead. They budget 10 years ahead. There's also supplemental funding in here for services and business systems modernization. for 2026 to 2034. Tax rates. Now, some of this is not so exciting. The Treasury Secretary Yellen and others have made the promise that none of the Inflation Reduction Act money will be used to increase the audit rate on those who make less than $400,000 a year. So whatever that means, if we were auditing 1% of everybody at the lower income level, that's the most we're going to audit now. No definition of audit. So all these people that get CP 2000s, that's not an audit. Earned income tax credit audits, does that count as an exam? I don't know. But they do an awful lot of them. So first, they'd like to increase the personal income tax rate to 39.6% from 37% for those making more than $400,000. Can you say Bill Clinton? Because that's the last time we saw rates that high. Now, I haven't been able to get a good understanding of what they're doing. I got to read through the Green Book. The Green Book explains these things. They want to increase the capital gains tax rate to equalize the taxation of investment and wage income. That sounds to me like they want to take away the capital gains rate. No preferential rate. You'll just pay regular tax rates. That would not be a good thing. That would definitely discourage certain actions. Now, they would like to increase the 3.8% Medicare surtax to 5% for those who earn at least $400,000. And the explanation is they want to shore up the program's trust fund. I have two comments there. First, there's no trust fund, especially for Medicare. Current Medicare income pays current period expenses. Unlike the myth of the Social Security Trust Fund, Medicare is a budget item and an expense item, nothing extra. Now, the 3.8% tax was one of the creations, I spelled that wrong, of 20 new taxes under the Obama administration, under the Obamacare. And it was designed to fund premium tax credits. So why they're going to use that for something else, again, I need to read down in the Green Book. It's not clear to me if they're repurposing some of this income or not. Donna made a comment on capital gains. You would still get the benefit of a deferral until realization, which is a tax benefit. Fair enough, right? In other words, they're not, unless I'm a billionaire, they're not going to mark my portfolio to market and tax me. I'm not going to pay tax until I sell it. Fair. Now, to Donna's point, Donna's going to be busy for the next 10 years. Ending the practice of stepping up the basis for gains in excess of $5 million per person and $10 million per married couple. 5.25 and 10.5 million today, respectfully, when combined with the existing real estate exemptions. This will ensure gains are taxed if property is not donated to charity. I thought that this is one of those sacrosanct things that would never be touched. So I'll let that sink in. No more step up in basis, kids. At death, anyway. Someone's going to tell me it's a constitutional issue. All right. Eliminating the use of carried interest by private equity managers. So carried interest is under current law. Investment fund managers basically pay a 20% capital gain rate on their income, right? The income from managing these companies that are owned by the hedge fund. So the hedge fund owns a C Corp. Money the C Corp pays out to the hedge fund for management is considered carried interest, and they pay a 20% rate on it. That may go away. I can't see it going away, but it may. Corporate tax rate would go to 28% from 21%. Corporate alternative minimum tax would go to 21%. U.S. Foreign tax that gets repatriated, we would raise that to 21% from 10.5%, which is a double of the Tax Cut and Job Act provision. Stock buyback tax, there's a surtax or an excise tax. Warren Buffett announces that there's no good deals out there, so they're going to buy back Berkshire Hathaway stock. Currently, they pay a 1% surtax on the value of those taxes. That will quadruple to 4%. Eliminate corporate tax breaks for compensation paid to an employee that exceeds $1 million. Now, that was a provision under Tax Cut and Job Act where we limited executive pay, the tax deduction on executive pay, to $1 million. Now we're saying if that poor guy makes more than $1 million, the shareholders don't get a tax deduction for any of it. It's an interesting proposition. Department of the Treasury's Green Book. I gave you a copy of it in the handouts and a link in the resources page. There's some fact sheets available on the White House page as well that explain some of this a little bit better. We probably could have done an hour on the budget, but I mean, I put you to sleep some weeks as it is, so we're not going to go there. Sorry. Ron Wyden again. The state of it, Ron Wyden is our friend, Democrat from Oregon. He chairs the Senate Finance Committee. So the state of the 2024 tax bill that is going nowhere in the Senate was discussed. He's frustrated that it's sitting there. Well, the Democrats have been very in favor of the bill, which is why it passed the House so easily. So anyway, he's frustrated about the stalling of the bill. His colleagues would like to make changes, would like to mark it up. He's concerned there may not be another chance to fully revive the business tax breaks for research and development, interest, and capital expenses, saying it may not be plausible to do retroactive credits for 2022 in 2025. It's amazing to me. Politico and some of these blogs are already saying that our friends in Washington, they've moved beyond the re-election, and they're all focusing on 2025. What do we need to see? Who wants what passed? Because Tax Cut and Job Act expires, they need to rebuild, recreate the they have to recreate our tax code for us. Otherwise, we're going to be partying like it's 2017 again. Republican senators are promoting an idea that we should just deal with all of this in 2025, let the 2024 bill go. Mike Crapo, I love that guy's name, from Idaho, remains steadfast that you can't pass any tax bill with all these things in there related to the child tax credit. I guess he doesn't like children. I haven't done any research on his family yet, but generally speaking, the Republican platform is opposed to the expansion of the child tax credit. They don't want it more than $2,000. They don't want it more than age 16. They definitely don't want it refundable. And in either a misunderstanding or an intentional warping of the facts, they keep saying that you don't need to work in 2025, starting in 2024, to get the child tax credit. That's not what that means. What it means is you can use as we did with the earned income tax credit during the CARES Act years, you can use your prior year income if that gives you a higher child tax credit, refundable child tax credits. Their argument is you can work every other year. The year you work, you get the child tax credit. The year you don't work, you'll use last year's money. I think while I'm sure that could happen, it seems a bit far-fetched. All right. Didn't we just see this? Oh, I'm going the wrong way. All right. The House is, so again, Politico says the House is starting to gear up for a 2025 tax bill. They're focusing on what those negotiations could look like. Now, this was interesting. So the House Ways and Means Republicans met this week on this, and they mapped out what their 2025 negotiations are going to look like. Now, they want to set up working groups. Certain groups will cover certain parts of the tax law, so everybody isn't an expert on everything. And they're going to educate the other members. But an interesting fact, of the 24 Republicans that were on the committee during late 2017 when the Tax Cut and Job Act got broken down, only 5 of those folks are still on House Ways and Means. So on the one hand, there's not a lot of experience doing this. On the other hand, there's not a lot of experience doing this, which might not be a bad thing. Adrian Smith of Nebraska, Vern Buchanan of Florida, Mike Kelly of Pennsylvania, David Schwenkert of Arizona, and Jason Smith, who's chair of the committee, is still on the committee. He's from Missouri, Missouri. So here's interesting. And an interesting number came out of this because I didn't catch this. I do watch when the IRS commissioner speaks or testifies, or at least I try to, and I try to get a transcript and go through it. The beauty of AI, the AI can look at the transcript for things for me. So the House Ways and Means Committee, the same guy from these guys here that were setting up working groups, apparently they're literate. They sent a letter over to Congress as well, to Commissioner Werfel. They're concerned about the impact of telework on the security and confidentiality of taxpayer information and customer service levels. Now, the Republicans are using that same argument, by the way, when we talk about the IRS direct file program in a minute. So 10 lawmakers signed off on the letter, and they asked the commissioner basically three things. How many IRS employees work from home? What limitations on telework currently exist? What confidential information do they have access to? Well, any one of us that have called in and spoken to somebody working customer service and we need transcripts, they have access to everything from home, right? The letter noted recent testimony of Commissioner Werfel, which I missed, where he testified that half of IRS employees work remotely at any given time. Now, in speaking with some of our colleagues, it seems that most IRS exams, they're not being scheduled high. Price is right. Come on down to the office. You're the next contestant. It's all being done remotely still. Some managers are making all their staff come in, and of course, they're making you come in for the exam. But generally speaking, around the country, no in-person exams. So if you look at the exam function, if they're all working from home, appeals are all working from home. I've had cases of both, by the way. I've had appeals managers working from home. I don't know how much, if you've got a couple of cases at a time, I don't know how much the concern is valid. But I guess we're going to learn some information here, hopefully. If not, we will do a FOIA request, right? So direct file is out for the entire country now, the 12 pilot states anyway. The new IRS online filing system went live for everybody. Previously, they were trying to balance things, so it would open up for short periods of time in certain areas. Now it's open in all 12 states. The administration has indicated that 15,000 taxpayers have used the tool so far. I was disappointed by that number. I would think the TurboTax gets 15,000 people in a given hour. They do like 20 million returns or some god-awful number like that. 100,000 are expected to use the tool during filing season. Well, you're more than halfway through that. So the next steps are going to depend on what the IRS measurements look like, but I say it's going to partially depend upon the election because the Republicans are concerned about the security of it, and there's also a lot of lobbying going on by Block and Intuit, who would be the two biggest losers of a direct file program. All right, so I'm going to give you a little take to exam here that I found interesting. So they found issues with improving the controls over manual refund processing. And this is interesting because the first thing you think about when they say that, when you read this is, well, I know they don't mean they're writing out a check and mailing it to me, right? That's my idea of a manual check. So take to define a manual refund as a refund that is not systemically generated through normal master file processing. The refunds are issued to individuals and business taxpayers, and you can see this happen when a taxpayer's master file account is flagged as deceased. Somebody has to go in and override the computer to release the refund. They have to make sure that the person is supposed to get it, that you're not doing a 23 return for somebody that dialed in 2020, the things that AI is going to take away, replace us, right? Manual refunds also go to injured spouse people, right? Somebody files that it's the 8736, they do the claim, and then the part that's supposed to go out, okay, yeah, I eyeball it, that looks right, out goes the money. On the business side, carryback losses are probably the best example. I want to make sure that they do it within the 45. The IRS wants to get that out within the 45-day period so they don't pay interest. Right. Are these out of order? Oh, these are out of order because this was supposed to go before that. So we'll come back to Guy. Additional actions are needed to improve the controls. So this was supposed to be the first page. I made a mistake, right? The audit was initiated to evaluate controls to minimize the risk of erroneous money. We already explained what a manual refund was, not done through the automated systems. We explained why it's done. So apparently TIGTA had previously looked at this in 2009, and they said, maybe it's time. Back then, they said there were deficiencies that needed to be corrected. Now, why are we looking at this? Remember, the TIGTA is not necessarily looking for wrongdoing. They're looking to evaluate systems and controls and processes. And also, if a program is implemented, they come back and say, did we do it correctly? Did you follow the mandate? And did it perform as advertised? Did it cost us more or less than we expected? Right? So anyway, they found that IRS processed 242,000 manual refunds, which I thought might be a little low when you think about injured spouse and some of this stuff. Totally $43 billion for calendar year 2022. That's a lot of refunds. And if you wanted to see that visually, 216,000 refunds generated $3.49 billion individual, 24,000 business returns generated $38 billion. And here we are. So they found some problems. They found no malfeasance. Let me start at the top. They found no one stole money or issued a refund they shouldn't issue. But there's room for that to be done if somebody were truly a bad actor. Employees were allowed to initiate refunds without the required training. Well, let's think about that. You might not know what you're doing, right? Look at some of the folks we know doing tax returns. They reviewed 5,000 employees, roughly, with access to initiate manual refunds. And they compared that to the training records, and they identified 653 people. That's what, 12%, 13%, who didn't complete the required or the refresher training. On the one hand, that's pretty good. 87% of the people know what they're doing. On the other hand, 13% don't. So they shared that list of people with IRS management, which part of TIGTA's mandate, I believe, is when they find wrongdoing, they have to turn it in, right? Whether it's one way or the other, whether it's for or against the IRS. If there's a wrong, they're like an ombudsman. They have to say, listen, guys, we can't be doing this. So they turned over those 653 people with access and no training. And then interesting comment. Remember that when TIGTA writes these things up, the IRS gets to come back. TIGTA can say, you didn't do this or this. The IRS can come back and say, well, we kind of did, or we disagree, or you've got it wrong. The IRS unit security representative stated there is no systemic process to ensure that the trainings are completed. So in other words, I'm on my honor to take the training before I go to work. Otherwise, system doesn't stop me. My manager doesn't double check the list ever. Nothing in place. Just go do your work. That's a problem. Internal guidance requires operational reviews be completed. There's no requirement that the accounting function ensure the reviews are accurate or complete. I'm sure that has since changed. And this was a problem. So they have something called certifying officers. These are the guys that look at the big refunds, the big cases, the court decisions. So they reviewed certifying officers that were, the IRS provided a list, and there were 3 employees who were not on the restricted command access list who were accessing this stuff. 2 of those 3 people accessed sensitive areas using a certain command code 52 times. I wonder whose tax returns they were looking up. Anyway, these allowed the codes that were accessed would allow someone to adjust tax, penalties, and interest on taxpayer accounts. They should not be allowed to both make adjustments and approve the payment, right? The idea here is checks and balances. Your bookkeeper prepares the check, the treasurer signs it, right? You don't have one person with both authority, checks and balances. Your president gets the mail from the bank and opens it and hands it to the bookkeeper. Internal control. The bookkeeper doesn't go get the mail. Certifying officers should not be allowed to approve a refund if they can also adjust the amount of the taxes. Hello. But the good news is they didn't identify any instances where someone did something wrong. They could have, but they didn't. Maybe that actually says something even better, right? Here's a hole we can drive, an audit hole we can drive a truck through, and nobody's taking advantage of it. It's a good thing. That was today's program. I know it wasn't as exciting as you would have thought. I did think we would have a whole lot more on tax preparer regulation, but I think we're going to need to follow up on that. I think that we need to encourage our national associations that we are members of to please pay attention to this, and where necessary, please step in on our behalf. All right, everybody. Oh, did I skip a slide? Yeah, but I think it was a repeat, Katie. So everybody have an awesome weekend. I'm going to be here doing extensions. I think West Coast people are going to be doing extensions too. By the way, another thing to watch at, your clients with estate planning, let's watch what happens in 2025 if they take away the step up in basis. So let's be aware of that too. Yeah, see you all.